This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. On the show today is William Poundstone. William is the author of Fortune's Formula. You must read this book, period. It's about the Kelly criteria. This is risk management, money management at its heart. All great trend-following traders have had to deal with Kelly. If they've had to deal with it, you have to deal with it. Bill's really had a wild ride with this story. I would love to talk to him all day long to figure out how he figured out all of this. Fantastic insights. I hope you enjoy. You know, I have to say, and I reread Fortune's Formula in the last 24, 48 hours. The thread that you had to weave for that book, that must have been terribly fun. I mean, how did you get this gig?
I went to MIT, and there I heard all these almost urban legends about Claude Shannon. So I started investigating that and the whole idea that he had used information theory in the stock market. And it just kept building kind of like a snowball, I guess. You found these different threads of it, and, you brought in all these incredible people into it.
No, it's fascinating. And I wanted to lead off with a quote, which I thought would be a good starting point to get people to understand why. And your book came out in 2006, but I would argue, it's not a sales pitch, but I would argue that anybody that's interested in investing, sure, they can go figure out the information in your book, perhaps somewhere else. It might take them a lifetime to do. So I would just recommend taking the shortcut and going straight to Fortune's Formula. But there's a great quote from Bernoulli, I think 1700s. A man who risks his entire fortune acts like a simpleton. And I think that really gets at the heart of where Fortune's Formula goes, doesn't it?
Yes, I mean that's a good common sense encapsulation of the Kelly criterion.
Well, let me jump into some big picture issues. I mean, clearly it's a dense work. There's a lot of detail, so we can only cover so much in a short period of time. But I thought there's some interesting connections in it to give the audience up to speed. I sent you some pictures that were my grandfather's uncle, who was a prosecutor in Chicago, and some pictures with him with Al Capone. And I think it's interesting, and I'd love for you to tell a little bit of the story about the close correlation, the intertwined aspect of bookmaking and the telephone industry in the early part of the 20th century, because they were intertwined, weren't they? And Al Capone was actually in there a little bit.
Yes, and I mean, that was really part of the big inspiration for the Kelly formula. So, I mean, it is very central to the story.
Why don't you go ahead and explain a little bit about how bookmaking and the telephone industry was intertwined? And we'll quickly get out of that and get back into Bell Labs and what ultimately came to be the Kelly criteria.
Yeah, well, in the early part of the 20th century, there was what were called wire services, which basically was how the illegal bookmakers learned which horses had run at the various racetracks. Now, nowadays with ESPN and everything, we don't think that's an issue, but it really was at the time. It was very important for these bookies to get the race results as fast as possible. So to do that, they had these wire services, which were generally run by organized crime figures. And what they did, they leased, phone lines from AT&T in order to transmit these race results. And this ended up being a very big part of AT&T's business. At one point, Mo Annenberg, who ran the largest wire service, was one of AT&T's very biggest customers, and he had all these mob connections. So it was very, closely related there. It was something obviously AT&T didn't like to talk about too much. But basically, these wire services were the origin of the whole idea behind the Kelly formula or Kelly criterion. At that time, John Kelly was a computer scientist at Bell Labs in New Jersey, which of course was this legendary, tech think tank that was run by AT&T. And they were allowed to do pretty much anything they wanted as long as it had some loose connection with the phone business or communications. And Kelly was aware of these wire services. He was also aware of a unique cheating scam on the game shows of the time, like the $64,000 question. At the time, that show was incredibly popular. It was produced in New York. It aired live on the East Coast, but it was delayed 3 hours on the West Coast. And there was a news story saying that one, West Coast gambler simply learned the winners by phone from the East Coast, and then he had like 2.5 hours to place bets with some of the most gullible people in California who didn't realize that the show had already aired and the winner was already known. And apparently, for a time, he made a certain amount of profit from this. So, Kelly was thinking about that, and it got him thinking of this whole abstract question. Suppose you've got, some inside tips on a horse race or, for that matter, the stock market. How can you use that to make the most money possible from that information? And what he intuited, I guess, was that there was a deep connection between that and information theory. Now, information theory was devised by his friend, Claude Shannon, who also worked at Bell Labs. And it's really the mathematical theory of communication. It's essentially the basis of our whole digital world today. Shannon was basically the guy who decided that computers should think with ones and zeros rather than digital numbers. And his information theory was really the basis of the Internet, all digital media today. So even though this was back in the 1940s when it came up with this, he's really, the grandfather of our world as we know it today. So a very brilliant man, and of course, Kelly was very intrigued by this information theory, as was everyone else at Bell Labs. But as he got thinking about it, he realized that the answer to his question about the optimal betting on fixed horse races was actually identical to a formula that was in Claude Shannon's information theory. He basically found this, if you've got these inside tips, you've got the question of how much to bet on each tip. Now, it might seem this would be a no-brainer, that if the 6 race at Belmont is fixed and Seabiscuit is going to win, you would simply bet everything you've got on Seabiscuit. But Kelly was smart enough to know that would not be a good idea because, there's always some chance that the tip is going to be wrong. And if you had this blanket policy of staking your whole bankroll on every, tip you get, your wealth would grow exponentially up until the point when you get your first bum tip, and then you'd lose everything, you'd be out of the game. Now, the opposite approach might be to just be very conservative and maybe place a minimum wager based on each tip. But if you did that, you obviously would kind of be squandering the real value of these inside tips you're getting. So Kelly did the math and showed that the optimal way of betting was kind of a middle course. You would scale your bets both to your bankroll and to how accurate those tips are. And he gave a formula saying exactly how you should do that. And he showed that this would do two things. First of all, it would give you the maximum compound rate of return on your investment. And secondly, it would guarantee that you would never go broke. But what he realized was that one of the formulas he came up with was actually, as I say, identical to something in information theory. Basically, he showed that the maximum growth rates you can expect depends on the bits of information you're getting in these tips as measured in, bits according to Shannon's notion of information. So this was really an incredible situation of drawing a connection between two things that were completely different. And it wasn't just a facile analogy. I mean, it was really a very profound connection. So Kelly showed this to Shannon, and Shannon was really intrigued by gambling and games, anything like that. So he encouraged Kelly to publish it. And he did that, but actually he got into a little trouble with AT&T over this, because this was the 1950s. And at the time, there had been these Senate hearings on organized crime and gambling, and they had publicized the fact that AT&T derived a lot of its money from these wire services that were, aiding and abetting illegal gamblers. So Kelly's paper was called Information Theory and Gambling, and AT&T executives thought, maybe that's not such a good idea. It'll suggest that maybe we're actually sponsoring research to benefit these bookies and gangsters. So they basically told him they'd have to give it a different name. And the title he finally came up with was A New Interpretation of Information Rate, which is just completely obscure and completely unsexy. And this publication was published in the Bell System Technical Journal. Now, as that suggests, it was really intended for phone company engineers back at a time when the phone company was landlines and rotary dials and human operators. So really, no one in economics or finance read that article. And for that reason, and partly because of this history of AT&T and the gamblers, that's one reason why the Kelly formula really took a long time to really become well known.
Well, as you mentioned the word tip, let me give it a little bit different terminology. And I know this is what you meant, but ultimately you mean an edge, a mathematical edge, whether you're talking trading or casinos and casino games. We're talking about a mathematical edge, and having that edge. And if you don't have no edge, no bet. And then that statement right there alone will cause a lot of people to go, hold on. What do you mean no edge, no bet? No edge, no bet.
Yes, exactly. He did actually talk of these rather, amusingly criminal examples like fixed horse races, fixed ball games, but what he meant was any sort of mathematical advantage. So classic example, if you're a card counter at blackjack and you do actually have a mathematical edge, you could use the Kelly formula. If you've got some great trading algorithm in the stock market and it does give you an advantage, you can use it there. But again, the most important thing, as you say, is that the Kelly formula says you bet only in situations where you do have a mathematical edge. So, if you're asking what's the Kelly approach to slot machines, obviously it's to keep the money in your pocket.
You mentioned something earlier here about the idea of, you think you've got a sure thing, but there's a small percentage chance you could lose. And the idea of accepting a small risk of losing everything, you will eventually lose everything.
Yes, exactly. And that's really the thing that sets the Kelly criterion apart from almost any other money management system, and the thing that I think makes it so relevant. Even since I've written the book, we've learned a lot in behavioral economics about people just systematically tend to be overconfident. If I'm a brilliant trader and I have what I think is this really unbeatable algorithm, it's just natural to, first of all, overestimate your edge, perhaps, and certainly to underestimate the error bars in all your estimates. So it's actually very useful to have a Kelly-type philosophy because it is a little more forgiving of errors in that it really tells you to shy away from any slightest possibility of something that would cause you to completely go broke. So in a sense, although this was basically motivated by simply the mathematics of what's the best way of optimizing your return from any sort of edge, it really is, from a psychological standpoint, a very good policy as well.
I think to people that are new to this style of thinking, you might say the highest compounded return without going broke. And I think most people would go, yeah, I want that. That sounds good to me. That sounds good. I want the best return I can get without going broke. However, as you mentioned, your fine school, MIT, there was some controversy here. And Paul Samuelson, very accomplished professor at MIT, he really never came around to this. Was it a direct? They were peers, Claude Shannon and Samuelson, and I guess Kelly would have been in the loop too. Were they all actively debating this in person, or was it only in papers and whatnot?
Well, Kelly died rather tragically young at age 41 in, I think it was the early 1960s. So he was really not part of this debate. But certainly Claude Shannon and Paul Samuelson were. And in the book, I go into Samuelson and other economist reactions to this, which might sound like it would be a really slow, boring part of the book. But actually, it's a lot of fun. And that's largely because of Paul Samuelson, who was just this wonderfully witty person who would, be attacking the Kelly formula, but with a good deal of wit. As to what his objection was, it was really twofold. For one thing, the whole efficient market theory was in ascendance at that time, and it was if you believe that there is no such thing as an edge in the market because the market is all efficient all the time, then the Kelly formula would be simply irrelevant, as it's irrelevant to slot machines where there's no edge. So that was one objection. But Samuelson had a subtler one that I think does have a certain amount of truth to it, and it's important to understand. He was basically saying that, again, from a behavioral economics point of view, most people just are not comfortable with the level of aggressive risk-taking that you have with Kelly betting or investing. Because you can show mathematically that, if you make a series of Kelly bets or investments on single opportunities, your bankroll is going to be highly volatile. In fact, you can make a chart of it, as I do in the book, and it's even more volatile than, say, the S&P 500 index. And a lot of people are not terribly comfortable with that. You can, in fact, show mathematically that at any given point in time, a Kelly bettor stands a 50% chance of losing 50% of his current bankroll at some point in the future. Now, of course, you will continue to go up after that. The loss is, you might say, temporary. But the Kelly bettor spends a lot of time being less wealthy than he was in the recent past. And at an emotional level, this is something that people find it difficult to deal with. So Samuelson was saying, okay, this is fine as a mathematical footnote, but when you look at real people, how they really invest, how they want to really invest, this is just too aggressive. And it's not really worth the heartache. And in some degrees, even Ed Thorp, who was, of course, for one thing, the inventor of card counting, a friend of Shannon's, and a very successful hedge fund manager, he sort of came to agree that, particularly in blackjack, most people just are not cut out for full Kelly betting in terms of the emotional up and down. But you really don't have to do full Kelly betting. You can use like 3/4 Kelly, half Kelly, and it turns out that most of the advantage you get with Kelly betting is actually available at say half Kelly betting. In that case, you would get 75% of the maximum compound growth rate, but with much less volatility. And a lot of card counters now believe that half Kelly betting is probably a better compromise there. So in that sense, I think Samuelson did have a point about the behavioral economics of this.
I have two follow-up points on Samuelson. So as we mentioned, efficient market hypothesis, Samuelson, Fama. And so that foundation really, at least from my perspective, was the foundation for the mutual fund industry to say, you can't beat it, just join us, and we're either going to have a mutual fund that closely mirrors the index or frankly, just the index. And what's interesting is if we look at what's happened from a performance perspective, we have seen in 72, 74, we've seen in 87, 2000 to 2002, 2008, 2009, I guess not in 87, but those other three instances, 50% plus downdrafts in equity indices. So what I find is interesting is, yes, Kelly, pure Kelly, very aggressive. As you point out, perhaps bring it down a notch or two, half Kelly. But the efficient market world that Samuelson and others were promoting was not without risk either.
Yes, exactly. And Samuelson it was his writings that were a big inspiration for the whole index market industry. He was suggesting something like that in a lot of his things. Yeah, I suppose, what he would say is that probably the average person should not even be invested in 100% in an index fund as well, because, again, these 50% drawdowns are very difficult for most people to take.
Yeah. One other point on Samuelson that I find interesting, and I don't think you brought it up in the book. I tried to search for it. I don't remember reading it, but he was one of the founders of Commodities Corporation. You were familiar with Commodities Corporation, I'm guessing.
Not that well. I've just heard of it.
Yeah, Commodities Corporation was basically a fund of funds, and they staked traders. And so under their umbrella, it's an operation that was eventually sold to Goldman Sachs. It still exists under Goldman Sachs now. But what's really interesting about Commodities Corporation is that many of the traders that traded there and became famous, that were in Jack Schwager's Market Wizards book, were technical traders, all believing they had an edge, all using Kelly-style betting strategies, all under the umbrella of the firm that Paul Samuelson started.
Oh, that's quite interesting. I wasn't aware of that. I do know, though, that, and I do mention that, Samuelson always was kind of the person to hedge his bets.
That's a pretty big hedge.
Yes. He was very skeptical of the idea that anyone can beat the market, but he invested in Berkshire Hathaway and obviously did quite well from that. So, it fits in with what I have heard.
A few names, for example, that came out of Commodities Corporation. I'll send you some stuff on it. You probably find it interesting. But Bruce Kovner, Ed Secota, Paul Tudor Jones, Louis Bacon, all traders that went for that, finding the edge and then having a Kelly-style betting, whether it was half or not. But the idea that it was right there. So it was really interesting. I thought that was, I tell you what, there's one other area I wanted to go in this discussion is long-term capital management, because I think that was a great example. And there's some other great books about that too. You go into it nicely. But long-term capital management, hedge fund that went belly up in summer of 98? I think so.
Yes, 98.
Yeah. And so the head of long-term capital management, and I'm going to shorten this a little bit, John Merriweather, formerly of Salomon Brothers, he was a Martingale bettor. Why don't you go ahead and define for the audience Martingale versus Kelly, because I think it'll be a good contrast.
Well, in the extreme form, Martingale simply means you when you lose, you double your bet and keep doubling until you win. So hopefully you end up with a relatively small profit. The problem with Martingale betting in the market or in the casino, for that matter, and it did actually start in the casinos, is that while it's a system that theoretically will work, in actual fact you have these massive drawdowns of your capital, and pretty soon you're going to end up with no cash, and you can't raise any cash to continue going on. And in short, that's basically what happened with long-term capital. They had, of course, many different bets that they believed to be uncorrelated. And they were uncorrelated in an ordinary market, but then when you have a sudden crisis in Russia, suddenly all those bets end up being correlated at just the wrong time. Now, the real problem was that they were using very high leverage, by some accounts like as much as 30 times. Thorp did a big analysis of this, which I think is quite interesting. He says that they were basically betting on situations where they might have like a 0.67% expected gain on a typical trade, and it was only the leverage that made this something better, or something that they could really sell to investors. But it was, kind of ridiculous at that time. I mean, even Treasury bonds were selling at 5.5%. But, it was basically a case of where they had these two Nobel Prize winners on staff. They could, Merriweather was this wonderful salesman who could really make this sound like this was the new scientific thing. But basically it was based on an extreme amount of leverage. Now, if you look at what the Kelly criterion says of that, basically the Kelly criterion, as one person in the book I quote says, is a threshold. It's the boundary between aggressive betting and insane betting. And by insane, I mean that if you bet if your wager sizes are any bigger than the Kelly bet, you are basically reducing your long-term expected capital growth rate, while of course accepting much greater volatility. So there's really no excuse for doing that. If you're very aggressive, you might want to make a full Kelly bet, but it's probably better to be maybe 3/4 or half Kelly. That does give you a little more breathing room in case some of your estimates were off. But long-term capital was kind of a perfect storm. I mean, they were sure they knew exactly what the correlations were. They knew exactly what the error bars were, and apparently they didn't. And since they were over-betting, they were really in big trouble when they had this financial crisis. According to Thorp's analysis, I mean, it seems quite possible that in terms of Kelly betting, they were betting about twice the Kelly bet. And if you look at the Kelly equation, that basically says that your long-term capital growth rate is predicted to be 0. You can, of course, make a lot of profit before the first big catastrophe, but in the long run, you're basically making nothing at all. And that seems to have been confirmed by the actual history evidence.
You know, the law of large numbers can be good for you if you've not really produced any return and you're practicing Kelly correctly. But the law of large numbers, if you're over betting, will eventually catch up to you as well.
Yes. I mean, there's so many things in life that, gambles we take that really are ruinous if you do it in the long run. And you have to make this judgment call. I mean, maybe you don't want to take up a very dangerous sport because you figure eventually you're going to be in some horrible accident. But when, there's also a risk involved in driving a car, in taking an airplane. And I suppose if you were really planning on living forever, you probably shouldn't ever go in an airplane or drive a car. Mm-hmm. But of course we do that. But the Kelly criterion, basically takes that long-term approach and says, if you want to be in business indefinitely, this is what you've got to do. You've got to avoid these risks of losing all your bankroll. And as I say, the real irony is that this hedge fund called itself long-term capital management. But the long-term wasn't very long for them.
Hey, Bill, why don't you go ahead and just take a few minutes? He's really one of the stars of the book, which is Ed Thorp, who really ties together so many of these. And I mentioned at the beginning of the podcast, there's a thread here that's terribly fascinating that there's just no way we can fill up in 30, 40 minutes. So, but why don't you go ahead and take a few minutes to describe Ed Thorp? And he used Kelly not only on casino games, but as an investor. And his investing track record, I don't remember it off the top of my head, but it was right there Warren Buffett-esque, wasn't it? For 20 plus years?
Yes, very, very definitely. So he's really the person who ties everything together in the book. Ed Thorp was a mathematician. He came to MIT, and while he was there, he read an article about some people who had done mathematicians, I believe at the Aberdeen Proving Ground, actually, who had used early computers to try and devise an optimal strategy for blackjack. And he thought that was interesting, but Thorp realized that he could probably come up with a better way of doing it. So he did come up with this strategy now called card counting. Because in blackjack, if you keep track of the cards as they're played, at that time they were dealt from a single deck, you would know something. You would know, how many aces are left in the deck, and how many high cards, how many low cards. And if you could use that to adjust your strategy in terms of how you play and how much you bet on each hand. And he was able to show that you could get a real advantage of this, generally a percentage point or two, but, it's amazing to have an advantage in any sort of casino game. So after he came up with this, he wanted to get it published, and he figured the person he should go to was Claude Shannon. So he got an appointment with Shannon, and, his secretary was very forbidding, said, Mr. Shannon really does not like to talk to people that long. He's very busy, so make sure you get right to the point. Well, he went in there, he talked about this blackjack system, and Shannon thought it was wonderful. It was the most amazing thing he'd heard. Because Shannon was really intrigued by, as I say, anything to do with games or even toys or, machines and so forth. So he thought this was great. And he helped him get this paper published. Now, when it was published, it got tons of publicity, as you might expect. And he got all sorts of offers from gamblers who were offering to stake him in Las Vegas. Because, Thorp had not really used this. He had just done the math and published this paper. So finally he got a visit from one of these people, who was a man by the name of Emanuel Kimmel. And he showed up in a Cadillac between two gorgeous blonde women in mink coats. And he was this, short guy in his 60s. So he got out of the car, he talked to Thorp and seemed to be quite impressed with him. So he said, okay, he's going to give Thorp $10,000 to play in Las Vegas or Reno. They ended up going to Reno, actually, because Kimmel said that he was too well known in Las Vegas. So obviously he did have some sort of connections there. So they went to Reno in a little over 27 hours or something like that. Thorp had more than doubled his money with this system. As I say, the only catch was that the agreement was that Kimmel got to keep 90% of any profit he made. And Thorp had agreed to that because, first of all, he wasn't sure there would be a profit since he'd never actually used this in a casino. And secondly, he thought this would just be a fun experience. He was planning on maybe doing a book about it. And, of course, he did write a book, which is, of course, is Beat the Dealer, which remains the Bible of card counting. So for several years, he was a mathematician, but he would keep going to Las Vegas to play cards, and he regarded it as his personal ATM machine because he could make money so easily. But after the book came out, it got a lot harder because the casinos started passing his picture around. They would bar him. His counter move was this, he had a friend who did makeup for Hollywood, so he would wear these disguises. But even then, the casino people got pretty good at spotting him. And 2 times, they actually put Mickeys in his drink while he was gambling. So after a while, he decided that, it's probably easier to make money somewhere else. And he decided, why not the stock market? Because this was something that was actually mentioned as a possible application in John Kelly's original paper. So he started looking into that. He ended up starting with warrants, which at the time were really the only kind of options that the average retail investor could work with. And he figured, if he could find a way of predicting which warrants were underpriced and then buy those warrants, he would be in good shape. He could use the Kelly formula. But there didn't seem to be any way of doing that, so he sat down and came up with his own mathematical way of valuing warrants. And this was essentially what we now call the Black-Scholes formula. But of course, this was before Black and Scholes had published it. And so by applying this formula, basically, Thorp found that most warrants were really overpriced. They were almost like carnival games, costing way too much based on what you could win and your chance of winning it. But he did find a few underpriced warrants, so he began trading them, and he really did pretty well. And it kind of snowballed from there. Friends began giving him money to invest. He kept, compounding what he made. And eventually he started a hedge fund called Princeton Newport Partners. And this has become, quite legendary both for the consistency of its returns and its very high returns, which I think were around 22% over a 28-year period. So it was really pretty incredible. And he used all sorts of different trades, but he always had the Kelly formula to decide how much it would be okay to risk on any particular one. But there is kind of an interesting end to that story. As it turned out, their main broker was Michael Milken. And this was the time when Rudy Giuliani was an ambitious, federal attorney who was trying to investigate insider trading and various things like that. So they ended up raiding the offices of Princeton Newport Partners to try and get evidence against Milken. And, it's very hard to run a hedge fund when you've got that kind of publicity, so they shut down the hedge fund. And a few years later, Thorp started his own because he was not involved in any of the illegal stuff. He was actually on the other coast. He operated out of California, where his computers generated the trades, and it was his partner in Princeton who, was actually schmoozing with Milken and the Wall Street people. But it was, kind of an amazing American success story of this guy who came from a very humble background, was really a mathematician, but he realized that there are so many ways of applying this and really became a big success as a money manager.
The entire, as I mentioned again, the entire thread of this, I guess I can see how you said it just kept building and building, and it must have just been, even like in our conversation today, and I'm suspecting that you will probably get off the phone with me and double check my insights about Commodities Corporation because it does tie right in. It's pretty amazing. And I wish Paul Samuelson was here to ask him further questions about it. But listen, I tell you one last thing is interesting for me that happened to me in the last couple of years. I had a chance to interview Mike Aponte, and Mike was the team leader for the MIT Blackjack team that became famous in the book and the film. So they too were inspired by Thorp all those decades later, and were still able to look back and rely on Kelly to make millions of dollars.
Yes, exactly. I think Thorp actually told me that he did get a letter from them, and there was a little bit of correspondence there. But that actually goes back a while. In fact, even before the blackjack, Thorp and Shannon collaborated on this wearable computer that would predict roulette. It was actually able to predict which quadrant of the roulette wheel the ball was liable to land in, because, it's basically just physics. So if you get the right information, tap it into the computer, they really could predict and get an advantage there. And they went to Las Vegas and managed to make a little money from this, but they figured that the blackjack gave them a better edge. It
is fascinating stuff. I highly recommend my audience to read Fortune's Formula. And like I said, if you think you could figure out all the details in this book, as an author of 5 books myself, I can tell you can't, unless you want to spend 10 years of your life trying to go obtain all this information. So take the shortcut and go to Amazon. That's my plug, Bill.
Well, I appreciate it very much.
Hey, listen, thank you for joining me, and thanks for providing my audience a great education today.
Well, thank you. It's been fun.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.